With a fortune of over $60 billion, considered by many the greatest stock investor of all time, you can pretty much say that Warren Buffett is indeed a very important figure in the world of finance. So let's check some of his most useful words of wisdom when we talk about the top 10 Warren Buffett financial advices.
Superfinances.
Number 1. Don't believe just any piece of news that you hear, because not all of it is true. In the world of stocks, some news is simply wrong, some news is miscalculated, and some news is false yet still spread on purpose to confuse fellow investors. Warren stated that, owners of stocks, however, too often let the capricious and often irrational behavior of their fellow owners cause them to behave irrationally as well. So he believes that it's very important that investors should not let others influence them and should avoid listening to the pundits of the trade too. An example he gave to back this was that stock prices of brands like Coca-Cola and Johnson & Johnson can sometimes temporarily drop. And at that point, people will try to pull out or give poor advice, which suggests that one should. However, anyone who understands the trade will keep their stocks and eventually be rewarded for it, as certain brands are safe bets. Number 2. Never invest in a business you cannot understand. Warren has stated that everyone should only invest in businesses that are not overly complex. The reason behind this is that, aside from generally being at a risk, if you invest in what you don't comprehend, it's also very easy to be fooled by others. A person could pretend that something is very profitable, and you might believe it due to a lack of knowledge, but in reality, it would be a useless investment. So, although expanding your horizon is not always a bad thing, in general, try to stick to what you know, as time will reward you nonetheless. Number 3. Excessive diversification is a poor strategy. Warren Buffett states that diversification makes very little sense to those who know what they're doing and strictly advises against having overly diversified stocks. The reason behind this is that it gets very difficult to keep tabs on different companies, and you gain very little profit when you combine all of your own stocks together since they are not unified. In 1960, Warren's largest position was 35% of his entire portfolio, which shows his dedication in keeping his efforts focused. Another reason he stated for this mindset is that you don't see good companies selling their important stocks too often. So when a good opportunity comes around, put out the buck, not the thimble. Number 4. Investing is neither easy nor complex. Many people find investing in stocks intimidating, but Warren says that, you don't need to be a rocket scientist. Investing is not a game where the guy with 160 IQ beats the guy with the 130 IQ. He believes that if you have a general understanding of money and the stock market and know what reputable names to invest into, you don't need to be an overly smart person. However, at the same time, he does advise investors to not get too cocky or look for shortcuts because there is no easy button. Referring to models that try to stick to get-rich-quick formulas, he stated, too often, though, investors forget to assume the assumptions behind the models. Beware of geeks bearing formulas. So don't be intimidated, but don't try to find shortcuts. Invest properly and wait for the fruit to bear. Number 5. Knowing the difference between price and value is important. Stock prices are always going up and down. Someone who does not understand how things work might assume that this means a change in the value itself. However, that's not always true. For example, a company that is not doing that well can have its prices pushed up due to a number of different reasons, and those who invest in that time will suffer losses when it does return to its true value. Whereas, if a company like Coca-Cola has a temporary drop, it's still wise to invest in it because it's a very valuable asset. Warren stated on the topic that, during the extraordinary financial panic that occurred late in 2008, I never gave a thought to selling my farm or New York real estate, even though a severe recession was clearly brewing. His reason for making this comparison is that he believes even if the situation seems grim at a specific time, the value does not go away, and when things are back to normal, the profit comes back. Number 6. Keep stocks held long-term, if not forever. If you aren't thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes, is the mantra that Warren believes in. He says that if you manage to buy a high-quality stock, you should not give up on it because it will be very disappointing to see how far it goes in the future if you have let go off of it. Warren has held on to certain positions for decades, and if we know anything right now, it's that it's worked out greatly for him. Trading activity affects the investment returns since buying and selling stocks causes the profit to die out due to taxes and trading commissions being in play. So the advice here is to buy good stocks, be patient, and hold on to them for as long as possible. You lose more by impulsively trading than you would if a stock took some time to generate value. Number 7. No compromises on business quality. Although this might sound like an obvious piece of advice, when you're put in the position where a stock seems cheap but profitable from a company that does not do that well in the market, it's easy to be enticed by the seemingly profitable long-term investment. However, Warren has done this in the past and it made him change his perspective on the topic, saying that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So ultimately, investing in a good company but with more money is better than going for cheap options that might never return any profits. Number 8. Only listen to those you know and trust. As one of the previous pieces of advice in this video mentioned, Warren believes that you should avoid following formulas or listening to geeks and pundits who act like they know everything about the trade. Instead, you should only invest in those who you know and can trust, such as competent management and companies that will never lose their value, such as Apple and Microsoft to name a few. When stated, once management shows itself insensitive to the interests of owners, shareholders will suffer a long time from the price-value ratio afforded their stock. So, only invest in places where the management seems to care about you. Number 9. The right strategies can be boring. Warren Buffett stated that, "We make no attempts to pick the few winners that will emerge from an ocean of unproven enterprises. We're not smart enough to do that and we know it." The reason behind that statement is that it's not a good idea to take too many risks even if it feels like the more exciting thing to do. Instead of trying to find underdogs in the industry, simply go for companies that have proven their worth over time and invest in them for a long time. That is safer and boring, but ultimately a smart thing to do. Number 10. Low-cost index funds are a sensible choice. Warren Buffett advocates for passive index funds. It may come off as a surprise due to how successful he has been in the stock market, but it makes sense when you look at the reasoning behind it. Low-cost and passive indexing can be a great strategy for many investors to consider, because a lot of the stock pickers fail to generate performance that would justify their higher fees. Most investors fail to beat the market, and many actively managed investment funds charge fees that are too high and greatly affect the investment returns. So it makes all the more sense with all of this in mind that Warren tells people to avoid sticking to advice that is based on history. A direct statement on this topic is found in his instructions to his trustee at the time of his passing. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. I suggest Vanguard's. I believe the trust's long-term results from this policy will be superior to those attained by most investors. So there you have it. 10 awesome financial advices from the greatest stock investor of all time. See you on the next video.
Superfinances.